In this video, I'm going to discuss 10 different ways you can receive benefits, tax credit, and tax deduction from Canadian government. Some of these benefits are easy to get when you file your tax return, and some of them need some financial planning. Be sure to stick around to the end of this video where I share a tool which search all of these benefits and give you an estimated benefit amount which you are qualified. Hello everyone. If you are new to this channel, my name is Ahmed Mahiyan. I'm a certified financial planner and I share my financial strategies so that you can implement them and achieve financial independence. So the first benefit is the old age security. So this is the government benefits that is given to Canadian citizens and permanent residents who are over 65 year age. You have to be over 65. That's the first criteria. Then the second criteria is you have to be a Canadian citizen or legal resident at the time they approve you the old age pension application. As long as you lived more than 10 years in Canada and you are a resident of Canada for tax purpose, then you are qualified for the old age security. Obviously, you will not receive the maximum amount and you will be given based on how many years you lived in Canada. If you lived in Canada for over 20 years and you moved to a different country when you are retired, then you can still get some old age security. Now, let's take a look at how much you can get from this old age security. So if you are in between age 65 and 74, then the maximum amount you can get is $707. And if you are over 75 years of age, then you get a boost, which is a 10% boost from the base amount. And right now you can qualify for almost $780. Now, all of these numbers are inflation adjusted. What that means is every quarter, the government looks at the CPI, which is the inflation indicator, and then they adjust these payment based on those numbers. So oftentimes, since the inflation number is positive, you will see a boost in your old age security every quarter. If you are a newcomer who lived in Canada for only 20 years and then you apply for the old age security, so whatever the maximum amount, you will get half of that, because to get the maximum amount, you need to stay in Canada for at least 40 years. If you're living in Canada for 10 years, you are going to get 25% of the maximum amount. And if you live in Canada for 30 years, then you get 75% of the maximum amount. You get the idea that whatever number of years you live in Canada, you divide that number by 40 and you get the percentage from the maximum. There is a related concept, which is the old age security pension recovery tax. What that means is if you are making too much money or if your retirement income is above a certain threshold, the government is going to think that you actually don't need the money and there are other people who will be better off because they're in a low tax bracket. So what the government does is after a point, the government is going to recover some of the old age benefit that they given to you. As we can see from the chart, in 2022, the recovery threshold amount is roughly around $82,000. If your income is over $82,000, any additional money that you are going to get from other sources will reduce your old age security. And that reduction is 15% every dollar you make. By the time you go above these high cap, all of your old age security benefit will be recouped by the government. All of these numbers are inflation adjusted every year. The minimum recovery tax threshold amount is $87,000 in 2023, and the higher cap is around $142,000. And for anyone who is over 75 years of age, that upper cap is $148,000. So when you are dealing with a financial planner, one of the planning that is done is trying to make sure that you have a smooth income over your retirement years so that none of this year you have too much income, which will reduce your old age benefit. Option number 2, the guaranteed income supplement, or in short, it's called GIS. So the guaranteed income supplement is given to low-income families, and in order to qualify for this guaranteed income supplement, you must have income that is below a certain threshold. So let's take a look at what are those criteria to qualify for a GIS income. So to qualify for a guaranteed income supplement, you have to be again over 65 age of years, and you have to live in Canada for tax purpose, and you are receiving an old age security. So that's a big requirement to qualify for GIS, that you need to apply for old age security. And if you are single, you need to have less than $21,000. And this is a number for 2022. And this number is going to go up as we go in the future years. If you are married or have a common law partner, and that person is receiving an old age security, then your income needs to be less than $28,000 to qualify for this GIS. If that person is not receiving an OAS, then it has to be less than $51,000. And if the spouse or common law partner is receiving an old age allowance, then the threshold amount has to be less than $39,000. Now let's take a look how much you can get from guaranteed income supplement. It really depends on your marital status. So if you are a single person and your income is less than the threshold amount, right now you can get approximately $1,000 a month. So that's roughly $12,000 a year. If you have a spouse who is receiving full old age security, then that amount is reduced to $625. Same goes if you have a spouse and they are receiving allowance, then it's same amount. And if you have a spouse who do not have any other pension income, then they're boosting up a GIS amount and they will give you as if you are a single person. So you heard me saying allowance a couple of times. So what exactly is this allowance? So allowance is given to someone who is between age 60 to 64. What that means is they're not qualified for an old age security, but their spouse is over 65. So the spouse is receiving old age security, but the other spouse is not able to collect old age security because they haven't reached the same requirements. So the younger spouse is still a Canadian resident for tax purpose, and they have met the other requirement, but because they are not age 65, this is why the government is giving you something called an allowance to help you out with your income. Now, if the younger spouse is doing a job, then obviously their household income will be above the threshold and they will not be able to collect this allowance. Now, if you have a spouse who qualifies for this allowance, so the maximum that the government is going to give you is around $1,300 a month as of 2023. The next benefit is the Canada Child Benefit. So anybody who has a child in Canada and they qualify the requirements, then the government is going to give tax-free payment every month to eligible families. So who gets this Canada Child Benefit? Now, obviously, the child has to be less than 18, and the parent needs to be the primary caregiver of that child. The parent needs to be a Canadian resident for tax purpose, and their immigration status have to be one of these following. So it can be the Canadian citizen, it can be permanent resident. If somebody is claiming asylum, then that will be also qualified. And sometimes we see international students who have child or children, then they have to be in Canada for at least 18 months for tax purpose and before they can apply for Canada Child Benefit. Now, how much can you get from Canada Child Benefit? It really depends on how many children you have and their ages. And also, one of the big factors that affects the child benefit amount is your adjusted family net income. And the way the payment works is the payment amount will always be based on the previous year's tax amount. So how much maximum you can get? To qualify for the maximum Canada Child Benefit, your income needs to be less than roughly around $35,000. So as you can see, if your child is less than age of 6, then you can get roughly around $7,500. And if the child is between age 6 and 17, then that amount is reduced to $6,200. Now, as your income goes up, the government starts to claw back some of this benefit. So in this example, the family has a child who is under the age of 6, and their family net income is $45,000. Now, we already discussed that to qualify for the max, your income has to be roughly around $35,000. There is an additional $10,000 that this family has, which is over the threshold amount. So because they exceeded the threshold, the government is going to reduce their benefit 7% for every dollar they make. As you can see from the example, that $10,000 is creating a $700 reduction from their child benefit amount. As you can see from the chart, the more money you make, the government is going to reduce your benefit amount the more. And obviously, the amount also depends on how many children you have in your family. So if you have a larger family, the reduction and the threshold amount will be a little bit higher. So you do not have to calculate any of these numbers. When you file your taxes, the government already knows how much money you made last year's tax return and how much your spouse made. So they are going to calculate the correct amount and pay you every month in the following year. So the number 4 benefit is student grant. So student grant is a program where the government is going to waive your loan amount in the form of grant. What are the eligibility criteria? In order to get this financial aid, you'll have to be a full-time student in a qualified program, and your income has to be less than a certain amount. And in this chart, you can see it really depends on how many family members you have and what is your income. For example, from this chart, you can see if you are a family of 4, in order to get the maximum grant, your household income has to be below $70,000. And if your household income is over $123,000, then you will not receive any grant from the government. This benefit is also calculated based on the previous year's family income. Now, if you qualify for the grant, how much can you get from this program? So the maximum you can qualify is $4,200 a year or $525 a month. So the 5th benefit is the RESP account. So Registered Education Savings Plan is a type of account which you can use to save money for your kids. Now, to encourage the families, the government is going to give you some grants and bonds if you contribute to that RESP account. Now, you can invest this money along with the government grants, and basically the purpose of this money is to help your kids in their university or college tuition, textbook, or living expense when they turn 18 and go to post-secondary institutions. So what are the benefits that the government gives? So everybody who opens up an RESP account and contributes money, they get a 20% grant from the government. And in a lifetime, the child is eligible for a lifetime contribution of $7,200. But there is a catch. The government is only going to match up to $2,500 a year. What that means is, let's say you open up an RESP account and you contribute $2,500 for your kids' education. The government is going to give 20% of that $2,500, which is $500. Now, if you haven't contributed any money in the past years, then there is a 1-year catch-up provision which you can use. But for most parents, $2,500 is the maximum that they can match. And if somebody is below a certain income level, there is additional grant from the government. So from this chart, as you can see, if a family member has less than $53,000 of household income, then there is additional grant of $100 if your income is below $53,000. If the family income is over $106,000, then there is no additional grant. Now, another government benefits that the RESP account qualifies is something called a Canada Learning Bond. So this amount is given to low-income family, and this low-income family definition changes every year. But if somebody qualifies for this benefit, then there is a $2,000 lifetime contribution that the government is going to get. So the family will receive $500 for the first time and then $100 every year for the next 15 years. So what is the definition of low-income family? So as per CRA, if somebody has a family members of between 1 to 3, the adjusted income level has to be less than $50,000 to qualify for this benefit. If a family has 5 family members, then the income level goes up a little bit, and that amount is $63,000. So number 6 is the RDSP plan. So Registered Disability Savings Plan, in my opinion, is the most generous program that we have in Canadian landscape. What is RDSP plan? So RDSP plan is an investment account for someone who qualifies for disability tax credit. So someone with long-term disability, and the government thinks that disability is going to hamper their earning potential, then they might be eligible to open this RDSP account. So getting disability tax credit certificate is the mandatory requirement to open this account. So the application process for disability tax credit is a little bit cumbersome, but CRA has been working on it for the last few years and made it really simple. And I hope that this program becomes more available to regular Canadians who qualify. What are the benefits of this account? The basic ideas of RDSP is families which has a family member who is disabled. When they contribute to this RDSP plan, the government is going to match dollar for dollar. Sometimes that match can be $3 for $1 contribution. So depending on what income level their family has, these government grant and bond can be very lucrative. So let's take a look at what are those benefits that this RDSP account provides. There are two types of benefits that is attached to this account. Similar to this RESP plan, there is also grants and bonds. So the grant is given to the account holder, and the maximum amount someone can qualify is $70,000 for the lifetime. And similar to Canada Learning Bond, the RDSP bond portion is capped at $20,000. So if someone has a low to modest income, then they qualify for this $20,000. Now, one of the benefits of this RDSP plan is sometimes this plan takes longer time to get approval because of the medical process and the approval process that needs to be get from the authority. So sometimes even if a family qualifies, let's say 3 years prior, and the process takes long time to get approval, then the government is going to allow you to contribute for the past years. So this is something called a carry forward amount. So if somebody missed contribution to RDSP plan, they can still contribute up to 10 years prior to that year. That's a huge advantage for families who didn't know about RDSP plan or who didn't get all the paperwork done. They can still go back up to 10 years and contribute for those missed amount. And the government is going to back calculate and gives you the money lump sum. I was fortunate to help one of the clients when I was at the bank, and she got 3 years of back payment, and she got a very huge amount from the government. And she, to this day, is very grateful to me because up until our discussion, she didn't know about this RDSP plan. If somebody qualifies for the disability tax credit, make sure to check out this plan because this is one of the most generous plan from the government. Now, how much bonds and grants you can qualify for from the government? It really depends on how much your family income is. The RDSP plan is, unlike the other benefit, the way the RDSP benefit is calculated is they look at 2 years prior to that current year. So what that means is, let's say you are applying or you contribute money to your RDSP plan in 2023, they're going to calculate the benefit based on your 2021 year's tax return. So most of the other benefits we have seen so far is based on the last year's tax return. RDSP plan is based on 2 years prior to the contribution year. As I said, if somebody's income is below a certain amount, they can qualify for the maximum government grant. And how much that can be, how much grants and bonds somebody can qualify, it really depends on the family income. So CRA has 3 income thresholds which they use to calculate these bonds and grants. The first threshold is $35,000. So anybody who is less than the first threshold, which is like $35,000, will qualify for both the government grants and the government bonds. So that's the maximum somebody may qualify if they are a bit less than $35,000. Between $35,000 and $53,000, the government bond will be clawed back. So similar concept to the previous benefits that we have seen so far. If some family has too much income, the government thinks that they shouldn't qualify for the bond. These bonds will be clawed back, and any family that is making over $54,000, they will have no government bonds for this RDSP account. Now they can still qualify for the grant amount, and the grant amount will be 300% for the first $500 contribution. If a family contributes $500, the government is going to give $1,500 for that $500. the next $1,000 contribution, the government is going to make $2,000. What that means is if a family contributes $1,500 in the RDSP account, the government is going to give $3,500 from the grant portion. They may not qualify for the bond, but they will qualify for the grant. And as the family income goes above $177,000, they will receive a reduced amount. And at that point, it will be a dollar for dollar matching contribution. Now, one of the planning opportunity here is the definition of family is slightly different than what we have seen in the other benefit program. If the person who is disabled is less than the age of 19, then the way CRA calculates the family income is by taking the parents' household income. So if the parents are making about the threshold amount, the benefits and the grant will be based on their family income. But if the beneficiary is over the age of 19, then the definition, the way the CRA calculates, so if the beneficiary of the RDSP plan is over age 19, then their income will be used to calculate this benefit. The beneficiary, if that person is the age 30 and that person does not make any money or they have very little income from their job, even if their parents are multimillionaire, they can still qualify for this RDSP benefit. So there is a planning opportunity to time when the benefits will, to time this contribution to maximize these benefits. Unfortunately, in Canada, most of the financial advisors do not know about RDSP that much. And that's why getting a planner who understands these nuances is very critical. And one of the requirements in the RDSP plan is the money has to be in the plan for at least 10 years, except few exceptions. But in order to keep the grant and bond money from the government, the money has to be in the account for at least 10 years. Otherwise, the government is going to claw back if the family withdraws the money within 10 years. And one of this challenge about this RDSP plan is because these plans are so complex, not all financial institution offers these RDSP plan. Only a handful of big banks offer this. And that's one of the reasons why these accounts are not opened by people who genuinely qualifies for these benefits. Number 7 is various tax credit that you can qualify to reduce your tax payable. So the first tax credit we will explore is GST and HST tax credit. This is a quarterly tax-free payment that the government pays to low and modest family members. So to qualify for this benefit, in fact, that the family income has to be less than a certain amount. This is one of the easiest to get if somebody is below a certain threshold. If you want to know more about the GST and HST tax credit, I made a video previously. You can check that out. All the details about this tax credit. Basically, what it is if somebody qualifies, then they will receive a tax-free payment from the government. And if somebody is single, that amount is around $500. If somebody is married and or has a common law partner, that amount is $650. And somebody who has child, they can also get some extra money based on number of children they have. Now, the next tax credit is disability tax credit. This is a big one because in order to get the RDSP account opened, you need to have these disability tax credit approved. This is a non-refundable tax credit, which will allow you to offset your taxable income. In order to qualify for this disability tax credit, there has to be at least 12 months since that person is suffering from one of these activities. What that means is if somebody is unable to walk independently for at least 12 months, then this will qualify for disability tax credit. Now, this application process is so complicated and it needs to be approved by a medical practitioner. So depending on the type of activity, there are medical practitioners that needs to certify that this activity is not being able to perform properly because of this restriction. And then once you get that medical practitioners approved, then you need to submit the application to CRA. Now, there is a company, Benefit Tools, a fintech company that is helping Canadians to apply for this complex application. I am not an affiliated person, but I found that a software company very helpful. And there is the founder of this company are 2 medical doctors and a financial professional who personally have family members who have some sort of disability, and that's why she is in a mission to help other Canadians. So I highly recommend you check out the Benefits to website. You will find that in the description below, which will help you to apply for this disability tax credit if you qualify. Now, imagine that a family qualifies for disability tax credit. They can reduce their taxable income and pay no taxes. How much money they can receive from this tax credit? It really depends on their age. So as you can see, if somebody is over 18, that the disability tax credit amount is almost $9,000. And if somebody is less than 17, that amount is a little bit more, and that amount is approximately $14,000. You can see that this is based on 2022's number, and as this will be adjusted based on inflation. Now, the next tax credit is Home Accessibility Tax Credit. This credit is given to those families who need to modify their home to accommodate a family member who needs mobility access. So let's say a family has parents who needs to modify their home to allow them to use their wheelchair. And if they spend $10,000, that will generate a $1,500 tax credit that they can apply against their other income to reduce their tax payment. In 2022 and subsequent year, that amount is increased to $20,000. So what that means is if somebody is spending $20,000, that can generate a tax credit of $3,000. And that can be a planning opportunity to maximize the tax benefit. The next tax credit is Canada Caregiver Credit. This is the benefit that is given to family members who are taking care of another family member. So it can be a spouse, it can be a child, it can be a grandchildren. So basically, a family member who is spending time and money or a dependent who is physically and mentally impaired, and this definition has to be approved by the government, they can qualify for some tax credit. So how much tax credit that they can qualify? It depends on the age of that dependent person. As you can see from the screen, it is roughly around $7,500 a year. So the next credit is Canada Credit Training. So this is a refundable tax credit, which helps Canadians to cover some of the cost of tuition, some of the cost of training fees. So if somebody is in the age between age 26 and age 66, and they're taking a course or training which is eligible according to CRA, then they can use this credit to offset that tuition. So how much can you get from this benefit? It really depends. So the amount is the lesser of the following two, which is your Canada Training credit limit for the tax year, or 50% of the eligible tuition that you pay to the course provider. Now, how do you know about your limit? So every year when you file your taxes, the government calculates based on the information you put, and on your notice of assessment, they tell you how much your Canada Training credit limit is. The next credit is first-time home buyer credit. So if you are buying a property for the first time in Canada, you can apply for this credit. And what basically that is, once you apply, you can get a $1,500 tax credit, which will help you to cover some of the cost of owning property. So before the year 2022, this amount was $5,000. And after 2022, the government increased that amount from $5,000 to $10,000. So what that means is you get 15% of $10,000, which is $1,500. And if you have other tax payable, then you can use that $1,500 to offset that tax payable. So the next credit is Climate Action Incentive Payment, which is basically you do not have to apply for it. It's automatically calculated. And based on the province you live in, this amount varies. So to qualify for, basically, you have to be over age 19 to qualify for this benefit. There is no other income test for this benefit, and everybody gets a quarterly payment from this program. Now, how much money can you get from this program? It really depends on the province you live in. I live in Ontario, so I can give you the Ontario numbers. So if you are an individual single person, then that amount is $488 as of 2022. If you are married, then each married person gets half of that amount. And for every child under age 19, you get a little bit of money from the government. So the next credit is a tax credit that you qualify when you buy an eligible zero emission car. So the government basically what it is trying to do is encourage people to buy more electric car or more environment-friendly cars. And one of the way they can incentivize is giving some tax credit. If you go to this website and you go for the eligible vehicle list, then you will see that as long as you are buying one of these eligible vehicle, then the government is going to give you some credit. And how much credit you will get, it really depends on the purchase price. So if you are buying a passenger car, the purchase price has to be less than $55,000. And if you're buying a wagon or pickup truck, then the amount has to be less than $60,000. So how much incentive can you get? Again, it depends on the car. It can be anywhere from $2,500 to $5,000. And how do you know about this? When you buy your car at the dealers already know these numbers and they will tell you upfront when you are trying to buy and negotiate the contract with them. The number 8 benefit is employment insurance. Anybody who is living in Canada, who is an employee of a company, they are participating in employment insurance benefit. So basically there are 3 main benefits of this EI program. So the number 1 is the regular benefit, the second one is sickness benefit, and the third one is maternity and parental benefit. So the regular EI is for people who got laid off from their job and they're in the process of finding the next job. The regular benefit does not work if somebody voluntarily quit their job. So it only applies when you are in no fault, meaning that your employer fired you or laid off as part of the group or fired you for no fault. So in order to qualify for this, you have to be one of those. Also, you need to have enough insurable hours to qualify for this benefit. Now, the insurable hours depends on where you live, and sometimes the government makes adjustment to this policy. For example, when we had the pandemic in 2020, the government adjusted the qualifying hours to make sure that enough people is getting EI benefit. And sometimes when we have economic downturn in seasonal economy, for example, when a few years ago there was a fire in Fort McMurray and there was wildfire, so the government made some adjustment to this program so that people will qualify for this benefit. Now you can get maximum up to 45 weeks of benefit in the regular EI program, and the maximum amount you can get is $650 a week. So how much can you get from this EI benefit? So it really depends on how much you made during your insurable hours. So when you are working, if you are making over 100,000, they will not match that. They will only match 55% up to the maximum yearly insurable amount, which is also known as YMPE. So as of 2023, the YMPE amount was $61,000. 55% of that $6,100 will give you $650 a week of benefit. So as the YMPE goes up every year, this benefit amount will also increase over time. Now, this next one is similar to the regular benefit. So the next one is basically for people who got a child. The mothers who give birth, they qualify for the maternity benefit, and the fathers, they qualify for the parental benefit. But basically, similar to the regular benefit, there is a maximum that somebody can qualify, which is $650 a week. The duration of this benefit really depends on what type of benefit you choose. So the standard maternity benefit is 52 weeks. And if somebody takes an extended maternity leave, that is 18 months. But this slide is showing you the parental benefit. So the standard parental benefit is 42 weeks and the extended benefit duration is 69 weeks. And the maternity benefit, which is available only to the mothers who give birth, that duration is up to 15 weeks. So as you can see from the chart, 600 is the maximum somebody can qualify. Now, one caveat is if you make money during this period while you're working because you are a self-employed person, then this benefit amount will be reduced. Now, the third EI program is sickness benefit. So this is basically anybody who is sick and cannot work because of some medical reason, then they can claim this benefit. So like the regular benefit and the maternity benefit, this also requires some qualifying hours, and the maximum somebody can qualify is $650 a week. In order to get this sickness benefit, somebody has to provide the medical record from a practitioner doctor and give explanation why they are claiming this benefit. Now, the number 9 is some deduction. So the number 9 way you can reduce your taxes is using some deductions. So in this section, I'm going to explain some of the deductions that are available, which will help you to reduce your taxes. So in order to understand deduction, first we need to assume some numbers. So I'm using a tax calculator from Ernst & Young. This is one of the big 4 accounting firms around the world. And basically assuming $100,000 taxable income for someone. So as you can see, I'm going to use Ontario as an example. Ontario, that $100,000 taxable income will require you to pay roughly around $22,000 tax amount. So that means your average tax rate is 22% and your marginal tax rate is 34%. So those who don't know the difference between average tax rate and the marginal tax rate, here's the quick recap. So average tax rate is the amount of money that you are paying divided by your taxable income, whereas your marginal tax rate is the amount of taxes you pay for extra additional income. So for example, instead of making $100,000, if you start making $110,000, that additional $10,000 income will be taxed at 34%. Because we live in a progressive tax system where the more money you make, your marginal tax rate will be higher at higher dollar rate. What that means is the higher marginal tax rate you have, it makes more sense to make more deduction from your income, because any deduction that you are going to make is going to be saving you taxes at your marginal tax rate. So now that you understand deduction, the first deduction that most people use is something called RRS, or Registered Retirement Savings Plan. Basically what it is, you are saving money while you are working. Because you are in a high tax bracket, your tax rate is much higher right now compared to your future tax rate when you are retired. Because most people in their retirement have a lower tax rate compared to what they have during their peak earning years. So imagine that you have $100,000 income and you are contributing $20,000 to your RRSP. So that means instead of paying taxes on $100,000, you'll be paying taxes on $80,000 because your taxable amount will be reduced. And that $20,000 contribution to your RSP will give you a tax refund of $6,200 in Ontario. What that means is when you are making money every month, your employer is calculating taxes based on $100,000 income. So they're sending CRA more money than the $80,000 actual income. So when you file your taxes and you show CRA that, hey, instead of 100,000, I only made 80,000, CRA is going to recalculate your tax liability and then send you back the $6,200 over contribution that you made over the 12 months in the previous years. So that's how the deduction works. Now, RSP is just one kind of deduction that you can use. There are multiple other deductions that are available to Canadians. One of them is pension adjustment. So this is a deduction that you get when you are part of a pension plan with your employer. So RPP is also very similar to the pension adjustment, but they're based on a different types of pension plan. I don't want to go details on that, but understand that pension adjustment, RPP deduction, RRSP deduction, all of them are saving you money for your future retirement. The next most common one is annual union or professional dues. So for example, if you are part of the union plan, for example, Enbridge, a lot of their employees are part of their union. So whatever union fees that they are giving to the union for as a membership fee, that union dues are deductible against their taxable income. Another common one is childcare expense. If you are sending your kids to a daycare and that daycare is costing you money, then you can deduct that daycare cost against your taxable income. And the last most common one is carrying charges. So if you're borrowing money to invest in the stock market and you are paying interest on that loan, then that interest cost is also deductible against your income. Now, there are some rules which will qualify and which will not qualify for the deduction, but for the purpose of this understanding, These are the deductions that are available to lower your taxable income. Now, the last benefit that somebody can qualify is the provincial health benefit. So I live in Ontario, so I'm going to explore Ontario's program. So the first one is OHIP Plus. OHIP Plus is for anyone who is a minor in Ontario. So they have access to almost 5,000 drug product that they don't have to pay, prescription drug. Anyone who is covered under the OHIP Plus is eligible to get almost 5,000 prescription drug for free if they are not part of any private pension plan. So another program is available for seniors in Ontario, which is Ontario Drug Benefit. Basically what it is, first $100 of the prescription drugs is paid by the senior. So this works as a deductible, and additional amount will be shared with the province in a co-payment agreement. If the senior is under a certain income threshold, then they also qualify for full free drug cost. There are some nominal fee that they have to pay, but basically most of their drug cost is free at that point. Then we have the Ontario Trillium Drug Benefit, which basically is whoever senior is paying a significant portion of their income in medical costs, they will be eligible for this benefit, where they don't have to pay more than $2 per prescription. But there are various nuances and within this program, so I don't want to go in details about this. And these programs changes all the time. So I would encourage you to go to the government website if you think that you qualify for these benefits. And the last benefit is basically Canada Dental Benefit. This is a program that was tabled by the NDP government last year, and the Liberal government approved it. Basically what it is, any family which has less than $90,000 income and they have a child under 12, they can qualify for any dental work and payment. Depending on the adjusted family net income, the family can qualify for any amount from $260 to $650, which is completely tax-free to the family. So here is the table that you can see. If you are making over $90,000 a year, then your family is not going to qualify for this benefit. And one of the rules for this benefit is you cannot have access to a private dental plan. Since you watched this video until this point, this is where I'm going to explain to you the benefit finder calculators that the government puts out on their website. This is a search engine tool that searches all this benefit that the provinces and the federal government offers to its citizens, to Canadians. So I'll put a link in the description of this website where you can go in, put your numbers, and figure out what kind of benefits you can qualify. And if you do qualify for one of these benefits, make sure to input the correct amount, and it will spit out roughly an approximate amount of benefit that you can qualify. This is a very long video, and thank you so much for watching this video to the end. If you like this kind of content, please make sure to like this, share this with your friends and family, because that will help us to grow our channel. And if we see growth in our channel, then we will be motivated to make this kind of video in the future again. And if you have any question, put it in the comment section so that we can make videos on those in the future and answer your question. Thank you so much for watching this video, and see you in the next video.